Why are people not rational with money?
The problem with the word rational, it tends to imply that our human need for emotional comfort is irrational. And I just don't buy that.
Timing the market, when to invest and when to not to invest.
There is not a single day in the whole of recorded human history when we couldn't find a good excuse for why the world looked like a bad place to get invested today.
So what then do we see as the big pitfalls of the emotions and the financial personality traits that people display?
You don't need me to sit here and tell you that to be a good investor, you should buy low and sell high. But our natural psychology does incline us to do the opposite, and that can be very costly. If we're always buying at the top and selling at the bottom, that's going to cost us a lot of money.
What is it about the human condition that makes us think, maybe this time it is feasible that I could have something that's going to have really high rewards and low risk attached to it?
We all feel more comfortable following authority and following the crowd.
I've even got my jargon klaxon here, in case any of my guests or I forget to speak in plain English. Hello and welcome to the Funkled pod. My name's Dan Russell and I've spent the last 20 years at the heart of the UK financial services market, involved in leading investment, insurance and financial advice businesses. And if one thing has become clear to me in that time, it's this. Most people don't have a clue what most of the financial stuff out there means because it seems complicated, boring and full of jargon. So we're going to change that. Funkled stands for Financial Understanding, Knowledge, Learning and Education, and offers jargon-free learning and loads of money topics, as well as tools to help you turn knowledge into action and make better financial decisions. So get yourself over to funkled.com, sign up and you can start your learning journey. But on the podcast, we delve deeper into the money topics you didn't learn in school with expert guests, and we'll always keep it jargon free. I've even got my jargon klaxon here, in case any of my guests or I forget to speak in plain English. Hopefully we won't have to use it. So on to our first guest for today. When we talk about money, we're usually told the same story. If you get the numbers right, if you stay calm, if you're logical, disciplined, everything will work out. But if that's true, why do people panic when markets fall? Why do we freeze when we should act? Or why do we avoid making financial decisions altogether? The answer is that money isn't maths. It's emotion, it's uncertainty, it's fear, it's greed, it's hope, it's avoidance. So to help unpack all of that, we're joined by Dr. Greg Davies. Greg is the head of Behavioural Finance at a company called Oxford Risk, and his job is to understand how people actually behave with money and make decisions. So today we're going to explore why people make the financial decisions they do, for good and bad, look at the emotional traps we fall into, and how we can put simple systems in place to protect ourselves when emotions inevitably take over. Greg, thanks for joining us.
Thanks for having me.
Let's get stuck in. Why are people not rational with money? Why do we not do the things that intuitively everybody thinks we should?
I actually don't like the word rational very much, if I'm honest.
Okay.
Because I think a lot of this comes down to the fact that if I'm going to make a decision, I don't just need to know what the right decision is. I need to be emotionally comfortable with that decision. I need to know that I'm comfortable pulling the trigger on that decision now. And the problem with the word rational is it tends to imply that our human need for emotional comfort is irrational in some way. And I just don't buy that. I think it is perfectly rational to want to feel comfortable with your decisions. It is perfectly rational to want to know that you can live with the decisions that you've made through the ups and downs of the markets and the stocks, etc. And so I think the right question is not why do people make irrational decisions? It's why do people make decisions that are emotionally comfortable in ways that are more expensive than they should be? Because that is the nub of it, is we all have a perfectly reasonable need to feel comfortable with our decisions. But if that need for comfort is costing us huge amounts of money when we could get the same comfort at a much lower cost, then that's the nub of it. So the question really is, To what degree are our in-the-moment decisions costing us too much money? And are there better ways of getting there?
That is a great way of putting it. And let me give you a real-world conversation I had just this weekend.
Mm-hmm.
A friend of mine told me, look, I've got an investment decision to make. He's got a bit of money that he wants to invest. And he said he was just holding off because he was so worried and uncertain about everything that's going on geopolitically, Iran, oil prices, etc.
Mm-hmm.
And he turned around to me and he says, "Did I think that was the right thing to do?" And I said to him, whether it's the right thing to do in terms of pure investment fundamentals, or it's the right thing to do for you, are two very different decisions. Yeah. I was explaining to him that it's timing the market, as they call it in the investment world, of trying to work out when to invest and when to not to invest and try to time the ups and downs is usually a fool's errand. It's very difficult to do. But time in the market, being invested for longer, tends to mean you ride these things out. Yeah. But as he was rightly pointing out, I'm really, really worried about it, and I really worry when stuff goes up and down.
Yeah.
So that's the nub of an awful lot of that division between real world decisions and supposedly rational decisions, isn't it?
So can I just pick on that example? So I think it's very interesting because we're at a moment where geopolitical risks are high, right? There's a lot going on in the world. And it feels that now taking your money from somewhere that feels safe, the bank account or, the mattress, if you're not inclined to be in the banking system, taking your money from somewhere that feels safe and putting it somewhere where there's a possibility that the moment you put it in, it could plummet. That is a very, very negative emotional trade-off for most people. And so to your friend, you're going, well, that sounds reasonable. It's a very uncomfortable thing for you to be doing. So why don't you just stay in cash? Here's the problem. There is not a single day in the whole of recorded human history when we couldn't find a good excuse for why the world looked like a bad place to get invested today. And if that friend of yours makes that same decision every year for the next 20 years and goes, oh, it's too uncomfortable today. It's too uncomfortable today. It's too uncomfortable today. I guarantee you that 20 years down the line, that is going to have been a very, very expensive set of decisions. So what we need to do is to recognize that it is an uncomfortable move and try to help people find ways, not of dumping everything in tomorrow, but find ways of helping them to more comfortably get invested over time so that the ultimate costs of buying that comfort that they need are not as big as they could be.
There's a statistic about time in the market and missing the best days of the market that's really interesting. And I'm going to use as an example the S&P 500, which is, and I don't need my jargon bell just yet, but the
why don't I get the jargon bell?
The S&P 500 is the index of the 500 biggest publicly listed companies in the US, for people who don't know. It grew 11% on average year on year in the 30 years between 1994 and 2024. So over 30 years, that meant that your £1,000 grew to £22,000-ish. But if you missed the best 10 days in that 30-year period, you only got 8.1% return. And your £1,000 was worth about 10,400 instead of 22,000. If you missed the best 60 days in 30 years, your £1,000 barely grew at all over that 30-year period. So that suggests, on the one hand, there's these big cliff edge moments, but there's also these big up moments.
Yeah.
And that's what people fear, but it's also, as you just pointed out, that's what people are missing, isn't it?
Yeah, absolutely. We don't know when the up days are coming. We don't know when the down days are coming. We do know that they're going to both be there, right? And so all we can do is prepare ourselves emotionally for that. But what we do know is that if you if your decision is to get invested versus sit on the sidelines, and this is for money that you don't need in the short or medium term. No, absolutely. If you're going to need this money next week, do not put it into the stock market, right? Because if it plummets between now and next week, that's a pretty bad outcome. But I'm talking about anyone who has money that they're pretty confident they're not going to need for the next 3 years, 5 years plus. Should I put that into the market and just suffer the down days and enjoy the up days, or should I sit with it in cash and wait? And I mean, the answer is put it in. Just get it in and put it to work. Now, that, as I say, can be uncomfortable to do. And so you might not want to put it all in at once. You might want to say, let me create a plan. I'll put some of it in on Monday and some of it in a month's time. And that's a more emotionally comfortable way of getting to work. But it's better than not putting it to work at all. An analogy I find quite interesting, and it speaks to exactly this one, is a lot of people say, well, the stock markets are just like a casino. They go up and down. It's completely random. You don't know when the up days are coming, the down days are coming. So I better stay away from it. Now, they're right. In the short term, the stock markets are like a casino in the sense that we cannot predict the outcomes day to day. But here's the catch. In a casino, if you go to the casino and play every day, over time, you're guaranteed to lose because the odds are in the house's favor. In investing, it's the other way around. If you stay out of the markets every day for the next 20 years, you are guaranteed to lose. So in the casino, in investing, we have this wonderful thing where we are the house, we are the casino. And your best bet is don't try to time anything. Just get your money in. Ideally, don't even look at it after that. Just let it work for you in the background. And you are then gathering the advantage of having the odds in your favor. You are the house.
You've done a lot of work on the emotional relationship that people have with money, and people's financial personalities.
Yeah.
Are there broad financial personalities that people fall into?
There are broad dimensions of financial personality, so different personality traits that people fall into. And so one of them that's very common to financial services and financial theory, and I'm just looking at your klaxon there and whether it's going to go off, but is risk tolerance. To what degree am I the sort of person that can stomach the risk of losing money in the long term for the potential of growing my money faster? And genuinely, there are people who are more capable of psychologically of taking long-term risks than others. And it's quite important to figure out where you are, because do you want ultimately a portfolio that is slightly riskier or a portfolio that is slightly safer? But that's all about your long-term trade-offs of outcomes, of the destination. A lot of investing isn't about the destination. It's about the journey. Can I stomach the ups and downs along the way, regardless of where I'm going to end up? And so there's a psychological dimension called composure. There are some people who are naturally more composed than others. They find they're less psychologically engaged with the moment, with the short term. So they find it easier to ride out the highs and lows. They become less anxious with regard to political events and market events, etc. They're more long-term thinkers, if you like, naturally. And there are other people who are more engaged in the here and now emotionally. Now, both of those can be good and both of those can be bad. And you might think, well, everything we've been talking about is the more long-term you are, the better. So it is generally true that people who are high composure find it easier to get invested and find it easier to stay invested. It can come as a cost. If you are too high composure, maybe you're a bit too laid back, a bit too blasé. You don't pay attention at all to what's going on in the world. You don't tweak your portfolio to adjust as things grow or fall. So it can come with its own costs of being too disengaged. But by and large, people who are naturally more composed people find investing easier than people who are more anxious people.
And those more anxious people are going to be the types that, if they do invest, are going to be opening up the app or the account every day and worrying, has it gone up, has it gone down?
Yeah, and it's more than just opening the app. I mean, they are more likely to open the app, but they're also more likely to have an emotional response to what they see when they open the app. So it is possible for a person who's high composure, maybe just out of interest, they still open the app every day, but they're just less bothered by the fact that today it's gone up by 2% and tomorrow it goes down by 1.5%, etc. So it's both, too much engagement and too much emotional response to the engagement.
Okay. So what then do we see as the big pitfalls, the mistakes that come as a consequence of the emotions and the financial personality traits that people display? You've got things like fear and avoidance in the first place, but then panicking once you do get in there, I guess, are the big ones, are they?
Yeah. So I'm glad you said that, because I was going to say something that often sounds a bit odd. The most reliable behavioral cost for most investors is in fact not all the stuff that they do once they get invested. That stuff can cost you money, and I'll just list a few of them. There's a natural tendency to feel more comfortable investing when markets are high and to feel more anxious when markets are low. Now, you don't need me to sit here and tell you that to be a good investor, you should buy low and sell high. But our natural psychology does incline us to do the opposite, and that can be very costly. If we're always buying at the top and selling at the bottom, that's going to cost us a lot of money. People do other things. They chase stories, they chase narratives. What's been in the press? What's the good news been about? And then they go and buy shares about that. By the time it's been in the world's media, it's too late for you to benefit from buying that story, right? You've got to buy things before the story hits the media. But people find narratives very comforting, so they chase narratives. They chase things that have been going up in the last year or two, which means they're of course buying high. People. They often will buy funds that are managed by star fund managers, big names in the industry. All of these are really bad reasons for buying a stock. The other one you hear a lot is, I love that company. I use their products a lot, therefore I'm going to buy the shares. Now, the fact that you use their products and their products good does not mean their shares are good value or bad value. It has nothing to do with it, right? So it's a bad reason to buy. But the fact that this thing is familiar, or maybe the company is headquartered in my hometown. These are all things that make people comfortable investing, and they can all cost you money, because you're not buying value, you're buying familiarity, you're buying a story. But the most reliable behavioral cost for most investors is not all these things that they do once they've invested. It's the most reliable behavioral cost is the fact that people are reluctant to invest in the first place. And they sit in money in their savings account, in cash, doing nothing year after year after year after year. And that adds up to absolutely vast costs over time. And so the biggest thing is just, can I get going in the first place?
Yeah. So getting in there, making that decision, and then having the time and the patience to ride out the market movements. Once people are invested, then they've overcome that initial barrier. What then are the pitfalls that psychologically they need to avoid?
Responding too much. In psychology, we'd call it an action bias. So the tendency to want to do something all the time. Now, the problem with wanting, and that's fine. Again, it's reasonable. It's not irrational to want to do something. If something's going wrong in your life, it's perfectly sensible to think, what can I do about it? The problem is, if in the short term, we don't know which days things are going up and down, short-term actions, by that logic, then become the casino. They become the crapshoot, okay? And you're not going to fix anything by making lots of short-term actions. So the tendency to want to respond to things as they happen once you're in the market is the biggest pitfall. It means people open the app too much. It means they see detailed information that has nothing to do with their long-term, with whether the portfolio is good for them in the long term. And it means they act too much. And every time you act when you invest, it costs you money. It costs you money because you pay a transaction cost to actually make the trade. And it costs you money because you are probably acting in a knee-jerk way on a short-term emotional response to something that isn't a sensible move in the first place.
What other major emotions do you think come into play in day-to-day lives now? For example, you can't pick up your phone and doom scroll on social media without being hit by some form of message about how you could be doing this with your money, or you should do this and you should do the other. What impact does this have on people's ability to see through the fog and make more constructive, better decisions for themselves?
Yeah, again, it's all of that stuff, and we could think of that as FOMO, the fear of missing out. And I talk about the biggest, most reliable cost for most investors being doing nothing, sitting on the sideline, not putting the money to work. The other danger is that you get enticed to put your money to work in a volatile way, in a way that is too driven by a single story. And we see lots of examples of this. If it's cryptocurrencies or this stock that's gone up or that stock, the stuff that's in the news, the stuff that the finfluencers of this world are trying to encourage you to buy in the moment, and you go, oh, that sounds wonderful, I don't want to miss out on that, and you act on a short-term emotional impulse, and you probably put too much of your portfolio into it because you're attracted by that one story. Good investing is never about putting money in one story. It's about spreading your money through lots and lots of stories. It's diversifying across narratives. And what most people feel more comfortable doing investing is investing in a small number of really compelling stories, which doesn't make a good portfolio, rather than investing in a large number of good investments. And so chasing these stories, that fear of missing out, that fear that if I don't act now, this money that this influencer on social media has just told me they've made in the last, 12 months. And also that's following authority. We all feel more comfortable following authority and following the crowd. So if there's something everyone else is doing, there's a bandwagon to jump on. It's got some well-known figures who are busy, blaring the trumpets from the bandwagon. These are all things that make us really comfortable taking unduly big bets on individual stories, and we should avoid doing that wherever possible.
I think there's a nice way of looking at it from my perspective is don't play somebody else's game with your money.
Yeah.
If the risk that somebody else is prepared to take and the time frame that they're working to could be completely different to yours. And if you're playing a long-term time frame, but somebody else is playing a short-term time frame, if you're playing if you want a slower, less volatile journey, and somebody else is prepared to accept that, then being enticed into playing somebody else's game is a big problem in that regard. And that's what you see an awful lot out there on the internet with some of the finfluencers, as you point out, trying to bring people in to things that really aren't fit for what their purpose of that particular pot of money is.
Yeah. Their incentives may be different too. I mean, why are they promoting this thing? Do they have some sort of ulterior motive, or do they get a cut of it? Whenever someone is promoting something very, very heavily, the first question you should ask is, what are they getting out of it?
Yeah. We have some modules on Funkled all around understanding the balance between opportunity and risk when it comes to investing. And it's clearly one of the areas that's key for people to get right when they choose to put their money to work. There is a tendency for us to want, isn't there, to want to believe the potential for high rewards with low risk. And I have a quick saying on that, which is, if someone's selling you high rewards and low risk, run 1,000,000 miles away from them, because there is no such thing. But what is it about the human condition that makes us think, maybe this time it is feasible that I could have something that's going to have really high rewards and low risk attached to it?
Because the really high reward is incredibly emotionally compelling. And what happens when you look at an option in front of you and there are trade-offs involved in it? Here's the upside, there's the downside. If the upside is really high, it grabs more of your attention than it deserves. And it means that the downside is sort of pushed to the back corner of your mind. So a lot of evaluating decisions and options is about making sure that all the outcomes get the attention they deserve. But when certain outcomes are particularly salient or particularly visceral or particularly exciting, or on the flip side, are particularly fear-inducing, those things tend to drown out the other information psychologically. And so we end up making decisions not by a balanced evaluation of pros and cons. We tend to get emotionally attracted to the big pro or the big con, and we end up making decisions that are very, very unbalanced. So a lot of it is about trying to control your focus of attention and trying to control, trying to let the counter arguments into your brain at the point you're making the decision.
Yeah. Is there a financial personality type or psychological profile that makes people more or less perceptible to financial scams as a consequence?
Yes, there's a bunch of them. So I think firstly, we've already mentioned composure. So people who are lower composure will tend to be more focused on the here and now and the immediacy, and they'll get drawn to certain details. That can make them more susceptible to scams. But a bigger issue actually is more around confidence of decision making. And confidence can be quite unrelated to your actual knowledge and competence. You can have people who are highly competent but are not particularly confident in their competence. They struggle emotionally to make the decisions and to have comfort in their decisions. And you can have people who know almost nothing, who nonetheless are highly confident, pushing buttons and taking the stab.
We've all met loads of those in our life.
Yeah, exactly. So those sort of things can make certain people particularly susceptible. I mean, it's not all psychology. Some of it is simply awareness and actual knowledge. It is important to build your. You can't. I mean, you can become a good investor with very little knowledge if you are emotionally disposed to the right sort of behaviors. But every investor is going to be made better by both things. One, building your knowledge and capability so that you're alert to things and you're aware of things. Two, being aware of your own personality so that you know where your weak spots are and how to design a system or a solution or a set of rules that help you to overcome them.
Yeah, so building up your knowledge and your understanding you can do that through the likes of Funkled, where you can go and find out about things like the building blocks of investment and understanding the trade-off between risk and reward, etc. How do people understand their investor psychology? How do they assess themselves, do you think, and then understand how they might be making decisions?
Yeah. I mean, the first way is just learning about some of these dimensions of psychology we're talking about: risk tolerance, composure, impulsivity, confidence. Once you're aware of them, you can start to think, where do you sit on that? At Oxford Risk, one of the things that we do as a core part of our business is we build actual financial personality assessment tools that allow people to very precisely measure their personality on many dimensions, and it provides outputs of that. And those mostly you would need to go to a financial advisor to have access to. That's another route, of course, is if you want to understand this side of things, often looking to people who have the expertise in that. Some financial advisors are particularly good at the emotional side. Some are not. So, pick your advisor well. I have, like Funkled, I have a whole online course, The Art of Behavioural Investing, which has an embedded version of this personality question in there, but plus a whole lot. I mean, as you say, if Funkled is about building your knowledge of investing and building that capability, the course that I've put together is all around the behavioural set and how do you understand yourself. And once you understand yourself, what practically can you do about it? Because an important thing is, it's very difficult for us to change ourselves to become a different person than we are. Our personality, like it or not, you're pretty stuck with it. But once you understand it, you can build the environment, you can build rules, you can build ways of making decisions that need you to become a better investor regardless of your personality. I mean, maybe can I just give you one example?
Yeah.
If you're an investor who gets very tempted by the short term and by what you read in the newspapers and in and out, I have something that I call the investor constitution. I've written for myself over the years a set of rules that are very specific to me and they are specifically there to describe how I allow myself to make decisions in a way that I know is going to help me overcome my own behavioral biases and proclivities, etc. So one of those rules I have is I only ever allow myself to make investment decisions on the weekend. Now, you might think that's a really odd thing to do because the markets are closed. And, what if something happens and you miss out on this great opportunity, or you don't allow yourself to pull out in time? But the reality is I work in finance, but it's not my job to watch the markets. But I've often been surrounded by other people who have all these screens on their desks and everything's flashing green and red. And I see something happening and I go, oh my God, I must change something in my portfolio. And the reality is I don't at that point have the space or the knowledge emotionally or with regard to the facts to make a good decision.
Mm-hmm.
So I'm making knee-jerk decisions. So I came to the decision, if I only allow myself to make investment decisions on the weekend, I immediately cut off that tendency to make short-term, emotionally driven, stupid decisions. I just don't allow myself to do it. On a Saturday, I can sit down and think, okay, I'm more reflective. No decision I make now goes live until Monday morning because I can put the trade in, but I can always cancel it tomorrow on a Sunday. So you build in an automatic pause point in your decision-making, and you've got the space, both in terms of time and emotional space, to make a thoughtful decision. And for many investors, that would be a great thing to do. Just stop trying to react to the market, period. And an easy way of doing that is to go, when do I allow myself to make decisions and where, and when do I not? And so even if you are the most anxious, nervous wreck of an investor, you can design your environment in a way that helps you to become a better investor. You're not going to change your personality, but you can become a better investor.
Yeah. So having those small rules in place that are relevant to you as an individual, you've got your own that fit who you are and where you work. But getting people to build those rules in to make sure that they avoid those emotional moments and overreacting is crucial, isn't it?
Yeah, absolutely.
I guess
just the notion of a pause point is one of the kind of simplest things in our decision making that can improve our decision making. And it doesn't have to even be financial decisions. Anywhere in your life, try to effectively in your decision making never push send the minute you've written the email, right? Allow yourself to have a little gap between deciding what to do and pulling the trigger. And for many decisions, that gap can be very brief. I don't know, go and make a cup of coffee. For a really big decision, sleep on it for a week or phone a friend, talk to people about it. But every decision benefits from a pause point.
Why do people find it difficult, do you think, to plan in advance around financial matters and end up making spur-of-the-moment decisions?
Partly because planning, I think, takes work, and we don't like work as humans. We like to act or avoid acting, but the planning is the bit in between, and it takes effort. A lot of people are daunted by the planning process because they think they have to get things perfectly right, and they're worried they don't have enough knowledge. And I think that's a big failure of investing, to think, oh my God, if I don't get it perfectly right, I shouldn't do it at all. Actually, you don't need to know a lot to get started in investing. What you need to make sure is that you don't get it perfectly wrong. But don't try to become a perfect investor, just start being an investor. And so planning, as long as what you're doing in investing is appropriately simple relative to your current state of your knowledge, then I think it does take a little bit of effort and work, and people tend to shy away from that, but it can make you a much, much better investor. An example where planning is very, very helpful. No human on earth has ever started their diet today, right? Or their exercise program today. We start on Monday, or we start on the new year, or we start next month. Because none of us like imposing pain on ourselves, but we're very happy committing our future selves to pain. My Monday self, that's going to be fine. They won't mind dieting. I don't want to diet today. Yeah. And so if your problem is getting going and taking your cash and putting it into the investment markets, asking someone to take all of their cash and put it all to work today is a very, very painful thing to do. But if you sit down with them and go, let's write down a little plan so that on Monday, we put 10% of your money to work. And a month after that, it's another 10%, and until we get everything invested. Just the action of writing down that little plan for the future makes you much, much more likely to actually get your money into the markets than if I try to make 10 individual decisions 10 months to go, should I invest today? Because then either the answer is no, or if it's yes, it's a very painful yes.
So planning, taking the emotion out, and giving yourself the break points to be able to make those, not rational decisions, but the decisions that are right for you and who you are is key. Greg, everybody who comes on the Funkled pod, we're going to be asking them the same closing question, which is much more personal to you and your relationship with money, and just as a little insight into you deeper. What do you now know about money that you wish you'd known sooner?
Oh, I think that's quite easy. Get going and take more risk when you're young, because I studied economics at university, so I theoretically was equipped to do this, and yet I didn't really start investing for myself until I don't know, my mid to late 30s. And when you're young, the amount of money that you actually have to put to work, unless you've inherited a great watch from someone, right, is pretty small. So you can afford to take the risks. You can afford to lose that money because you're gonna have a job and you're gonna re-earn it. Most people don't start investing and start their learning process when it's safest to do it and when it makes most difference when they're young. So I would say the simplest thing is just get going early. That's the main thing.
Greg, thank you very much. You've heard it here, ladies and gentlemen, from a doctor in the psychology of money decisions, that you need to not make rational decisions. You need to make the decisions that are right for who you are, for your financial personality type, for your lifestyle, for what's appropriate for you, and build the processes and the rules that are going to help you make the better financial decisions. And that biggest financial mistake that we see people making is literally not doing anything in the first place. All the other decisions that come thereafter can be handled with you've got that understanding about who you are and you put those rules in place. I guess we need fewer moments where emotion's allowed to make the decision for us. Because when the markets hit uncertainty, when they wobble, life gets busy, we can fall back onto short-term emotions, or we can fall back onto whatever systems we've put in place. This is exactly what Funkeld's been built for. You've got planning tools to help you make key decisions before emotion takes over. So you can set simple rules, clear priorities, guardrails, protect you in the moments that matter the most. Go and try out the budget planner or the savings and investments goals planner on the site and see if it teaches you a little bit about how you're feeling. Our learning modules go deeper into understanding your money personality, the emotional triggers, and helping you build some habits that work in real life, not just on spreadsheets. So if any of today's conversation has resonated, if you recognized yourself in any of the panic, the procrastination, or the second guessing, don't just nod along. Let's get Funkled. Greg, thank you very much indeed.
Thank you. Great discussion.